Want to predict a market crash? Just watch Michael Burry. Every time he places a big bet, people panic. But here's the thing, he shorted Tesla and the stock doubled. Timing the market is nearly impossible, even for the guy who got 2008 right. But there are 4 warning signs that show up before every crash. Signs you can spot yourself. And right now, all 4 are flashing red. Here's the thing about market crashes. They never feel like they're coming. Everyone thinks, this time is different. The economy looks strong. Your portfolio is up. Your neighbor just made 50% on some tech stock. Life is good. But beneath the surface, the same patterns are building. The same mistakes are being made. And the same 4 red flags are waving in the wind. The problem? Most people don't know what to look for until it's too late. So here are the 4 warning signs, starting with the most dangerous one. Red flag number 1. Everyone thinks they're a genius. This is called investor overconfidence, and it's the first domino that always falls before a crash. When markets go up for years, people start to believe they've cracked the code. They stop asking what could go wrong and start asking, how much more can I make? In the 1920s, people were borrowing money to buy stocks because the market always goes up. In the late 1990s, people were quitting their jobs to day trade .com stocks. In 2021, people were taking out loans to buy meme stocks and crypto. The pattern is always the same. When your barber starts giving you stock tips, when your uncle who doesn't know what a PE ratio is starts talking about his portfolio, when everyone around you is making money without really understanding why, that's red flag number 1. And if you think this doesn't happen anymore, just open X. Guaranteed stock picks, rocket emojis, trust me bro energy everywhere. When your timeline is full of people copying trades from strangers without any research, that's not a healthy market. So here's the lesson. When everyone around you is confident, when risk feels like it doesn't exist, when people are taking financial advice from anonymous accounts on X, that's when you should be the most nervous. Red flag number 2. The rules aren't keeping up. Every major crash happens because the financial system invents something new, and the people in charge either don't understand it or don't care. This is called regulatory failure, and it's the gasoline that turns a spark into a wildfire. In 1929, investment trusts were the hot new thing. They let people invest with borrowed money, and nobody really understood the risks. The government didn't step in because the economy looked great. Why mess with a good thing? In 2008, it was mortgage-backed securities. Banks were bundling bad loans, slapping AAA rating on them, and selling them to investors. The regulators? They were either asleep or complicit. By the time anyone realized what was happening, it was too late. This happened with crypto exchanges like FTX in 2023. Billions in customer funds vanished because these platforms operated with almost no oversight. And right now, AI trading bots promising guaranteed returns, platforms even their creators don't fully understand, and regulators scrambling to catch up. Sound familiar? The SEC and financial regulators are still trying to figure out how to oversee AI-driven financial products. Meanwhile, retail investors are pouring money into these black box systems with zero transparency. So when you hear about a new financial innovation that changes everything, when the people selling it can't explain it in simple terms, when regulators are nowhere to be found. Red flag number 3. Nobody understands the new thing. This one is sneaky because it feels like progress. A new technology, a new financial product, a new way of doing things. Everyone's excited. Money is pouring in. But beneath the hype, there's a problem. Nobody actually understands how it works. In the 2000s, it was collateralized debt obligations, or CDOs. These were bundles of mortgages that were supposed to spread risk, but they were so complex that even the people creating them didn't fully understand what was inside. When housing prices dropped, the whole system collapsed. Imagine someone offers to sell you a box. They say it's worth $10,000. You ask what's inside. They say, "Don't worry about it, just trust us." Would you buy it? Of course not. But that's exactly what happens before every crash. People invest in things they don't understand because everyone else is doing it. And when the box explodes, everyone acts surprised. And today, it's AI. Don't get me wrong, AI is real, and it's transformative. But right now, companies are slapping AI on everything to justify sky-high valuations. Take C3 AI. Stock surged 200% on AI hype, still unprofitable. SoundHound AI. Billions in market cap, losses every quarter. Investors are pouring money into companies with no clear path to profitability. It's the dot-com bubble all over again, just with a different buzzword. So if you can't explain an investment to a 10-year-old, if the people selling it use a lot of jargon and buzzwords, if it feels too complicated to be true. Red flag number 4, everyone's drowning in debt. This is the big one, the red flag that turns a correction into a catastrophe. Because when everyone is borrowing money to invest, to buy houses, to fund their lifestyle, the system becomes fragile. And when something goes wrong, it doesn't just wobble, it collapses. In 2008, people bought houses they couldn't afford with mortgages they didn't understand. When prices stopped rising, they defaulted. Banks failed. The whole system came crashing down. It wasn't just a housing crash, it was a debt crash. So where are we today? Here's what you need to know. Over the past decade, household debt grew 11.5%. Income? Only 8%. People are borrowing faster than they're earning. That's a recipe for disaster. This includes mortgages, credit cards, auto loans, and student debt. And the scariest part? This debt is growing faster than people's ability to pay it back. And it's not just households. Corporate debt has exploded too. Companies borrowed cheap money for years. Now rates have doubled. All that debt just got a lot more expensive. So when you see debt levels rising faster than incomes, when people are borrowing to invest in the stock market, when the system depends on cheap credit to keep going, that's red flag number 4. So let's recap. The 4 red flags that always show up before a market crash: investor overconfidence, regulatory failure, poorly understood innovations, and massive debt. And right now, all 4 are flashing red. Does that mean the market is going to crash tomorrow? No. Timing the market is impossible. But it does mean you should be paying attention. And when the crash does come, you can be the one buying while everyone else is panicking. Warren Buffett is sitting on $325 billion in cash. The smart money is already preparing. Are you?